Okay, I'm sure you can hear me now. Cool, thanks. We got tech issues figured. This is great. We have a small group today, which is kind of what we imagined, right? Because it's geared intentionally towards people that have maybe been doing this work for a minute, right? So and get some questions answered. So we hope to be a little conversational a little bit towards the end. But for now, I'm just going to kind of get us kicking off. And just welcome everybody to this session, which is Real Estate Development 401 with our friends over at Finance Fund. And so my name is Lisa Much. I'm the Communications and Capacity Building Director at Ohio CDC Association. This session is being recorded, and everyone who registered will receive a copy by the week's end. I'm going to edit out this weird part at the top where I try to make sure that you all can chat. And I think the preference is that as we have questions throughout, Jeff, correct me if I'm wrong, feel free to interject.
Yes.
Okay, cool. Because we are a pretty small group today. So it's not going to be, you can type a question in the chat if you want, and I can interject on your behalf, but also if you want to just go ahead, feel free to do that as well. This session specifically was designed based on questions that you all submitted at registration. Not everybody submitted questions, but many of you did. And so it's geared first around that. And then there's room, I think, to talk about other topics at the end. So, and so this is also Real Estate Development 401. And in case you missed it, we did conduct a 101 last month. And if you feel that's more that where you're at, I encourage you to watch it. It's on our website. But this is geared for people that maybe have been doing this work for a little bit longer. And I think I have said all of the things I wanted to say while trying to remember to admit people into the room. So, you know, we've only been doing this for a while. But with that, I would love to pass it over to Jeff Mohrman at the Finance Fund to lead us in this discussion. Keep introducing yourself in the chat, but for now, let's pass it on over to Jeff.
All right. Well, good morning. Thanks, Lisa. We had some technical difficulties this morning. I thought coming into the office for the first time in, I don't know, 14 months was a good idea to try to set up for this webcast, but I couldn't make it all work. So I'm on my cell phone right now. So the only people I can see talk are me and a couple others, I think, that pop up. So if you do have any comments or questions, please feel free to interrupt, and we'll go that route because I probably won't be able to see you. So I apologize for that. Thanks for the opportunity to speak again. We spoke last month. I don't know if any of you were on that Zoom as well, but we talked about kind of the basics of real estate investment and development. And it was, I think, a really healthy conversation, really talking a lot about the different pitfalls that come about as you're trying to develop real estate, and really the very serious due diligence work that is necessary to make sure that a project can be successful. So, you know, that was where we focused the conversations last month. We're going to shift a little bit more into, all right, you've done some of that work. You're now just trying to figure out issues typically around the capital stack, which we'll get into here in a little bit. So I'll step back for a second and talk about who we are and what we do. So Finance Fund and Finance Fund Capital Corporation are two 501c3s. Finance Fund was founded in 1987, is a statewide agency that has served 85 of the 88 counties, providing private and public capital to low-income communities and projects that serve low-income families and individuals. We have been in Columbus, I think, that entire time. Currently, we are the Columbus Commons right downtown, although we'll be moving into a new office here next year on East Broad Street in the Discovery District in downtown Columbus. So you'll have to come check out our new space there, and we'll actually talk about that project as part of this. So Finance Fund does quite a few different things. We're a new market tax credit entity, so we provide new market tax credits to commercial projects throughout the state, and have done a few outside of Ohio as well. We provide loans and low cost capital to affordable housing projects, community facilities, healthy food access, healthcare, and we've done that throughout the states. We provide grants. Hopefully many of you have taken advantage of our grant program. We have a pre-development grant, which provides up to $30,000 for housing projects, and an economic development grant, which provides $100,000 for commercial projects, typically tied around job creation. And those are annual awards that actually we are about to make announcements for the projects for 2021. So, or if we haven't already, actually. So we've been doing that for a long time. The new markets we've been doing for a long time, and have been pretty successful in receiving allocations of credits and getting those out to projects quickly that have had high impacts throughout the state. The loan side, which is through the Finance Fund Capital Corporation, which is a community development finance institution, is on the newer side of our business. It provides loans for, again, similar types of projects, but those projects typically are using our capital, one, for a variety of reasons. One, it can help potentially in scoring on an application. It could be that there's no other source of funds available that are easily accessible, so we can help bridge construction financing or equity or the permanent loan. We can step in where other lenders are simply not able to provide a loan because it doesn't meet their underwriting standards, where we can be a little more risk forward and allow for greater risk on projects, and look at different small business opportunities in areas that maybe larger banks just aren't able to or willing to touch for whatever reason. And a lot of times we also come in with other lenders where they have met their cost containments or their loan to value, and we can come in as some type of a second position or shared first position mezz debt. And we've done all of those things, and we will continue to do creative financing to help meet the needs of impactful projects throughout the state. Most recently, though, starting in July of 2018, which is when I came on as Executive Vice President of Real Estate, was to start a real estate equity and development arm. So we have been looking around for a while, trying to figure out where Finance Fund can make a big impact. And one area was using our capital to help provide new or preserved affordable housing, and to try to do it creatively through different programming that wasn't just the straight 9% once a year LIHTC application, but to do what we call middle income housing. Others have called workforce housing, although I think that's a bit of a misnomer. Permanent supportive housing without tax credits. We have done a few tax credit deals, and we've also provided, I think, what has been impactful equity dollars in projects, those that don't include tax credits, so that our source of funds, our cost of funds for a project are lower than if they went out to the private market, which allows then the project to have lower rents overall, and help meet the metrics of providing, I think there's a question here, of more of the naturally occurring affordable housing. So that's what Finance Fund does. We've been around again since 1987. If we haven't worked with you, I would say we'd love the opportunity to have those conversations and see if there's projects that we can do together on any of those different business lines that we have. So certainly reach out to me after this presentation with anything that you guys would like to discuss. So With that, though, I want to talk specifically today about real estate and the different and fascinating challenges that are in the market today that probably didn't even exist a few years ago, if not 18 months ago. So I actually just got off the phone, and Lisa, you can put up the slides. I'm just going to kind of talk for a little while, and as people have questions, we'll go that route. But really just want to speak on lessons learned and things that we're faced with right now and what challenges are being brought to the table. And we just got off the phone with a very large general contractor who do, they perform projects that range anywhere from 10 million to $100+ million deals, and anything from new mid high-rise hotels, commercial projects, to mixed use large residential developments. And they're struggling. They're calling their subs almost on a daily, if not weekly basis, trying to figure out how to get a reasonable construction estimate in today's market, or how to hold a contract that was provided to them for more than 7 days, so they have time to actually vet the estimates or the proposed pricing based on the designs. I mean, it is so, the market is so crazy right now, where lumber prices jumped so dramatically as lumber mill production was cut so dramatically during the pandemic, that all of these other materials are also following, whether that's PVC, steel, conduit for electric, it is, and even the panels themselves. I mean, everything is up in 100-200% increases over the last year and a half. So what do you do when you are faced with these potential massive cost overruns? And that's at the general contractor level, let alone thinking of it from the developer level of how do you put together a project and fill a capital stack so that you can service the debt and make sure a project is going to work. So those were conversations we had this morning, actually, right before this call, which always feel a little unsettling and kind of puts you a little on tilt. And actually the project we're discussing is what is called 366 East Broad Street. Vera on Broad is the name. It's where Finance Fund is going to move our offices to next year. We're building an 8-story mid-rise building, and connecting that to a 1920s historic office space to make 114 units of middle income housing, plus amenity space, plus office space, and trying to do that in a way that does not involve tax credits, or quite frankly, any other subsidy other than tax incentives that come through different structures. So some sales tax savings, possibly some property tax abatement, if not exemption. So, looking at some of those on the operating side, but from the capital cost, there is no subsidy of note. It's equity and it's debt, and it's pretty simple. So from that standpoint, so we're building this out, and what is different from a project like Vera versus a tax credit deal is the debt is the primary component of the project. It can be on the construction side, 70-75% of the loan to cost. So you're looking at, if it costs $20 million, 14-15 million of that is going to be debt. And then even if you can raise that money, which is typically the easier funds to raise, you're looking at how do you raise that equity, and at what price can you raise that equity? So these are the questions that you start getting into when you're looking outside of low-income housing tax credit projects, which let's get into. So Lisa, can you go down to, I think it's slide number 5. We'll just go into the first question here.
What strategies for property acquisition? Is that the one?
Yeah. Yes.
Okay.
Thank you. So this is a good question. And as I'm assuming a lot of the entities on the call are CDCs or other nonprofits working very strategically in target community or a few communities. This is something that when I was at the CDC, we were trying to figure out all the time. I mean, my background is working for the Franklinton Development Association, and if you don't know anything about Franklinton, it has been in the news as the up and coming neighborhood for the last 15, 20 years in Columbus. They built a flood wall. I think it was actually completed in 2003. And since that moment, they've been discussing how it's going to create a construction and housing boom in that neighborhood. And it's finally happening. So what happened in that first decade from 2003 really until I started in 2011 was a struggle of landlords, typically out-of-state landlords, that found buying a house for $10, $20, $30,000 to be a drop in the bucket and the best potential long-term return they could get with their capital. And therefore they were unwilling to put a dollar into the property, and they were unwilling to sell until they found the proper appreciation of the properties that they had. And they would buy them in chunks of 10, 20, 30 units. And back in the day when values of homes were not what they are today, and there wasn't such a demand for property, you would have these tax sales of that would include a bunch of properties, and the owners of these sales, typically, actually one of the largest was a loan servicing provider out of Nebraska called Nelnet, and they owned a substantial amount of property in our neighborhood. And it was impossible to get them to sell their property. So, what strategies are there for property acquisition? And here's the question: what strategies are there for property acquisition when a current property owner is disinvesting in his or her property and a community wants to incorporate that property into a redevelopment plan? Well, you gotta remember that on both sides of this, the bookend of property are personal, private property rights that we have in the United States. So that we take private property incredibly seriously. And in fact, there are volumes of law around the taking of property, whether that's done by an individual, a corporation, or the public through some government source. We value that if you own property, you have a lot of rights and can do to some degree what you want with that property. Obviously, that is limited by zoning and use restrictions and regulations, the requirement to pay taxes or other assessments on a property, and typically some level of upkeep is required. That if it's not occupied, that it's properly boarded, that the grass is mowed, things like that. That all come out of the zoning requirements of your community. So if you're putting together a redevelopment plan and you find yourself struggling with that, there's the first things you want to do are make sure that you have the true owner of the property, that it's not through 17 different shell companies, right? So you want to make sure you get to who actually owns the property. You want to see, are they actually paying their taxes, and are they in compliance with all code issues? So we have, and I've certainly made phone calls to our friends at the land bank, who also runs the code enforcement office here in Columbus, and told them about properties where, quite frankly, it was just high grass, but it was a property that had been a problem for a long time, and maybe there was a board or two loose, and they would come out, but that can become an incredibly tedious and long process. So depending on who the owner is, you may be dealing with someone that can throw money at the situation, hire some third party to take care of at a very cheap level, the code issues, and they don't care. They're not looking, to deal with the community. They're not even accessible. So then you look at, well, are they paying their taxes? Well, typically anymore, they are actually more likely to be paying their taxes because the value of the property is going to exceed whatever taxes they have on the land. Back in 2009, 10, 11, when we had the downturn in the market, a lot of people were walking away from properties because they were they were underwater, whether that was through the non-payment of taxes or through a loan that exceeded the value of the property. So it was a little bit easier to incentivize the transfer of the property. In fact, oftentimes you weren't dealing with the owner, you were dealing with the bank, because the bank was going to take possession of a property they didn't really want to take possession of, they just wanted it to be repaid. So you start looking at the code issues, and you look at taxes, and ultimately, if it's a property that is valued by the community and is going to be a property that's part of a redevelopment plan, the ugly truth of it is you're going to just have to pay for it. And if you can't come to a number that is both reasonable for you as the CDC or the land bank or other entity that's dealing with this, that the seller is willing to part the property for, then you just kind of have to work around it and hopefully wait them out, continue to put pressure on them, maybe try to find other ways to pull at their heartstrings that's not directly financial. But there is no like silver bullet. There's no magic to this. There's because we have very strong private property rights, which I think probably most people on this would agree is a good thing. There's not a whole lot more you can do. Now, there's some conversations, and I'm an attorney. None of this is legal advice. I've talked with a lot of other attorneys that start to look at public and private nuisance suits, so that is it affecting your private enjoyment of your land as a private nuisance suit, or is it collectively affecting the enjoyments of a community for a kind of an untold number of people? And can you convince a prosecutor to take up a public nuisance suit, or are you willing to file a civil suit as a private individual for a private nuisance? I don't know what the existing case law is on that. That has been brought up at different times. I've personally never gone down that route. It seems to me like it would probably be a tedious process. I don't know. I found that typically it's easier to solve the problems outside of court in general. So I don't know, but that has definitely been suggested as a potential. But personally haven't ever used it and really couldn't give any good direction on how effective that truly is. So at the end of the day, it's going to come down to typically money, right? And unfortunately, oftentimes the last person to sell, and maybe that person that has done the least investment in a property, is going to make the largest return. And that is why wealthier people will put a lot of money down in the neighborhoods like a Franklinton, because they know if they have a buy and hold strategy that ultimately they're going to get many multiples of their initial investment. Now, if they did that under, with margin, if they did that with debt on the deal, it does put a little more of a squeeze on them. But, if they have patient capital, there's not a whole lot more, unfortunately, there is to do. So there's, the strategies, though, if you are able to actually get to the person that owns it and you think you can buy the property, I would recommend that you find someone that can represent your interests. So, if someone like the city of Columbus, let's say, wants to get a property, it's not probably in their best interest to go as the city of Columbus and try to buy a property, right? They as soon as a city entity, or even some entity that the city has a direct relationship to, might have board seats on some created nonprofit, as soon as the seller hears that, dollar signs go in their eyes, right? Or if ODOT tries to buy some property to redevelop a highway, they're looking at, they're gonna get paid for this far beyond what maybe the market value could even be. What CDCs have the benefit of typically is being a nonprofit, being local to the community, so that others can vouch for them, but also in good and bad ways, probably having some cash constraints, right? They're struggling with revenue at times. So coming in as a potential buyer, like this is what the property is worth. This is the most we can pay, and maybe that can help move the needle. Certainly, we had that strategy back when I was there for a few years, and it worked really well. But at the same time, a piece of land that we sold, or that one little parcel we bought originally was $1,800. On that same block, the last parcel we bought was $20,000, and a half block over was just listed last month at a parcel the exact same size for $250,000. So, right, like it is ultimately going to be those that hold out the longest end up likely getting the most wealth, unless it becomes such an issue that you just kind of walk away from that whole part of the community in general, which can happen and sometimes should. You don't want to throw good money after bad. So Lisa, go down to the next slide. We'll just go to the next question, unless someone has a question about this or has any comments or other ideas that they want to throw them out.
Yeah, feel free to, there's a couple questions that come in the chat that I think are related to this, so we could do those now.
Yeah, sure, let's do it.
If you want. So one of them, I think this is the person that asked the question initially, but I don't remember, but the recommendations for sources of funds for strategic property acquisition. Yeah,
that's a great question. So if assuming that the buying entity isn't sitting on a pile of cash, there are a few opportunities, few lenders out there that'll do what they call quick strike money, or even potentially patient capital. So opportunities would be to partner with someone that does have deeper pockets. That could be potentially a larger nonprofit or a for-profit, and you do some type of a shared ownership, create an LLC, something like that, right? You can always go that route. If you don't have a friendly partner on this specific property that you're looking at, in Columbus, there's some funds specifically related to this. We actually created a $100 million fund, led primarily, I think, by Huntington putting in, they may have put in 50 million, a substantial amount of money. And those are, that's considered quick strike funds. That's administered through the Affordable Housing Trust of Central Ohio and Franklin County, or of Columbus and Franklin County. Other cities are looking at doing that too. I know Cincinnati is looking at putting together a similar fund, maybe for similar purposes. Finance Fund actually does a lot of that. I think there's some other CDFIs that do that. I don't know, Omar, if you're on here, but I know IFF has done that at times in the past as well. Which they're a competitor of ours, but also we hopefully all play well trying to move the needle on affordable housing. I know Ohio Capital, they have for housing, they've got a CDFI side. I think it's OCFC. John Welty runs that. They have some of that quick strike money, and depending on where it is, if it can meet CRA needs, if it can meet some rural housing needs, there's all these sub pots of money that can really make the cost of capital really low. So those, it couldn't be something where, well, right now you only have the foresight of buying it. You don't know what the long-term plan is. If you can commit to, well, this is going to be housing, or you can commit to, this is going to be healthy foods or a community facility, the more targeted you can get, the better those interest rates can become. So the one problem you don't want to run into, and kind of here's the pitfall of it, is you don't want to just buy a property because you think it's really important to have, and then you get in there and realize, well, it's going to take 3 or 4 years, and if you have a 6% interest rate on a $500,000 deal, you're paying a lot of interest eventually when you finally decide what you're going to do with it, and maybe the property doesn't appreciate at 6%, so you're actually buying something more expensive now than what the property is going to be worth in a few years, right? So you got to consider the time value of money. Beyond that, it's also something you want to make sure you do all your due diligence, right? Don't fall in love with the location until you know that it is actually possible to build whatever you want to do. You certainly don't want to start buying property and take on the liability of a site being dirty that can contaminate, other parcels, or could contaminate drinking water or something, along those lines. I mean, those are serious issues that can take entities out quickly. So, all of that, though, all of those concerns would be requirements of any of the funding sources I discussed, except for maybe the private equity. But even those entities, I think, are going to ask for a lot of due diligence. Your phase ones, your surveys, your code reviews, those things on the front end. So, unfortunately, it's tough to do all of that without spending some money. Certainly that's where kind of finance fund, when we have our pre-development grants, if you're looking at housing, can offset a lot of that. We can pay for some of that due diligence and on the front end. But it is tough to acquire property without spending money before you acquire it. I mean, even if you're buying your own house, right? Just getting a home inspection is the same idea. You want to make sure you do that before you close on any type of funding. Lisa, was there another question about that?
There was, and I don't know if you want to ask it, Landon, or if I can just read it, but for residential projects, does or can finance fund lend to individuals? For example, if somebody were purchasing a fixer upper from a land bank or CDC, can finance fund serve as a lender, providing a purchase and construction loan similar to $203K to a buyer, but more specifically tailored to the land bank or CDC's programming?
Yeah, that's a great question. As of right now, the answer is no. We don't have the staff set up for that. And let me get back to you, though. I know there was a couple groups actually that were looking to create funds. I think CHN in Cleveland may have created a program for that, some funding sources there as well. And then there was a group here in Columbus that actually is an association of a few other nonprofits, was looking at creating something for that type of individual. The issue is that, it's the administration of the funds, right? It's really hard to have construction draws and make sure everything is done and keep that cost of capital low enough that it works for the individual. So at the moment, the answer is no, but it's something that I know is being discussed, not just with us, but with other entities. So let me get back to you, because I don't know where the status is on some of those, but I'll try to help you figure it out.
Awesome, thank you.
Thanks. And that's, again, if you have questions, you can type them in, I can read them, or you can unmute and just interrupt. But I think we can move on to the next one.
Cool. So what strategies are successful in creating more naturally occurring affordable housing? What strategies can be used to ensure the long-term preservation of NOAA? Those are great questions. Those are questions that we have been struggling and trying to address really since I came on. And I think I got this question last week. So I started to do a deeper dive into naturally occurring affordable housing, and it came across actually some really interesting program or reports and articles on NOAA and whether or not, what it means. Is it necessarily something we should celebrate? Is it really naturally occurring? Which is interesting. So, one of the things that essentially, or there's really, I think they describing as three categories. One, it's unsubsidized, right? It's not a tax credit project. It didn't receive some large pilot grants to happen. Typically, they're at least 2 decades old. That the properties, and this is pretty true across the board, as things age, oftentimes they depreciate in value, because then the third component, they are either in need of revitalization and significant renovation, they have significant deferred maintenance, and they probably do not have substantial supportive housing programming around naturally occurring affordable housing. So, there's these units don't have, great MOUs with supportive service providers. There's no there's no next steps being looked at for a lot of the residents. So, we acquired, and I'm going to use this case study, and it was successful for us. Was it ultimately the most successful thing? I don't know. It's something we debate and discuss quite often. A project that was really in need of significant renovations, but certainly not, it was not a demo. It wasn't really right for a tax credit deal. It was about 40% vacant, and another 20% of the units that were occupied were 6 months plus behind in rent. And it was really because the owner had just not hired a property manager that was really doing anything. They weren't leasing out the units, they weren't collecting the rents, they weren't maintaining the properties, and the owner didn't have enough revenue then coming in to deal with the maintenance issues that had occurred because of that. So, as the property continued to deteriorate, the demand for the housing had gone down, which, says something in a market where the demand for affordable housing is just truly through the roof. So we partnered with an individual who brought all of the units back online, cleaned them up, put significant money into each unit, and really doing it in strategic ways, after addressing, mechanicals or structurals or roof issues, and making sure all the windows were safe and operable, and didn't have major environmental issues. It was putting new carpet down, getting sure there were functioning appliances in place, making sure the units were freshly painted and clean. It wasn't, you're not going to walk in and say, wow, you put $40,000 of renovation into the unit, because you can't. If you don't have a subsidy to offset that cost, you have to just do what you can. And ultimately, the rents were increased, but they were increased really to still a below market rate rent. And that was probably with about a 10%, 12% increase over the previous rents. But, the residents, most of them stayed. A lot of them moved from a unit that was in, semi-disrepair into one of the renovated units, and were willing to pay the increased rental rate because it was still very affordable. And I want to say it was like $750 for a 2-bedroom, something like that. So they were happy with the units, and they were willing to pay more to get out of a unit that was really in terrible shape, that they had maybe been paying $650 a month depending on. So it was one of those projects where it truly had a preservation of naturally occurring housing. And it was actually, this deal was in a more prominent location than where you find a lot of projects. It was that you might call NOAA. This was on a prominent corner in an up and coming part of a suburb that was demanding double that in rents on new construction projects, if not more. Just literally down the street. So we felt very good to come in, and the reason it worked is we brought low-cost equity to the deal. So this developer, this investor, had no problem getting the loan if he could find someone to put up the equity. So that's where Finance Fund stepped in, and we created a partnership, and we're a member of the investment LLC, and we ended up getting taken out when he refinanced with a permanent loan that worked for him, and we preserved some housing that way, and it was, I think, a win across the board. What we didn't do, and I don't know that we reasonably could, because we are truly putting our money at risk as it is, we didn't put any deed restriction on a property going forward. We weren't some grant source. We weren't acting as some government entity. So there was no deed restriction. I mean, ultimately, could he end up pushing those rents significantly higher? He could. I don't know. We try to find partners that are like-minded, but so hopefully that vision continues. But those, as long as we're in the project, we have the ability to influence it. As soon as you start putting some type of use or deed restriction on a deal, your money isn't just less valuable, it can become completely unattractive. So, we do avoid that where we can, and try to just work with partners that understand the mission. The strategies for acquiring it, really, it kind of almost goes back to the first conversation. Having access to quick capital, whether it's even all that cheap, doesn't matter for an existing property, right? Because all you're trying to do is get it into your possession. After that, you can go refinance, find someone else. Because if you can get it underwritten at a shorter term, lower amortization, higher interest rate, it looks even better if you can find some other source to do, an extended term with lower interest rates. So clearly the cash flow gets better if you can refi. So, that's not typically as big of a concern as it is with kind of the longer buy and hold strategy of, an unperforming asset. Right now, it's honestly finding properties. I was meeting with a bank yesterday, and they loan a lot to a real estate investments group, and that has a brokerage component to them. And this brokerage is getting multiple calls a day from California looking to invest in anything, including like the U-Haul or self-storage areas around town, and they're pricing them at a cap rate of 6.5, which is just kind of blew my mind. I mean, that they were willing to, sight unseen, dropping 100% cash, just not even, no due diligence, buying it the day it's listed at a 6.5 cap rate. And because they can't find anything above 4 in California, meaning that and as the cap rates get smaller, your return on investment is going to be less, right? Like, think of it in those terms. So they're just trying to find somewhere to put their capital that they can get reasonable returns, because they're all seeing what I think most people are experiencing, that there is significant inflation in the market right now. It's not just on construction, but it's in, you're starting to see it in other industries, and I think it's likely to continue. So, certainly these investors think that. And so they're trying to move their capital quickly. So if they're willing to do that on a self-storage unit, they're also willing to do that on what was affordable housing. So having a broker or an agent that's just constantly looking out for properties, and not just things that have hit the market, but actually going around to the communities that you're investing in and trying to talk to landlords and, really talk oftentimes to the property manager, get the full story, figure out what's going on, and hopefully get a referral to a connection to the owner and try to make a deal that way. That is, oftentimes a way that can be successful. As soon as it hits the market, you're now competing against other entities. So finding things before they hit the market is obviously a benefit. Having that capital ready to go so that your offer is really attractive. It doesn't have 1,000 different contingencies, right? Like you do your due diligence before you make that offer, and you try to do that before it ever hits the market. So you're just trying to be quicker and smarter than the other person on acquiring these things. And then, if it's probably anyone on this call, your whole intention is to ensure the long-term preservation of the affordable housing. So, that is clearly your intention. So how do you do that if the property needs substantial renovation? Well, you got to look at properties that you could potentially push the rent and still keep them affordable to cover the increased debt you're likely going to have on the project to do the renovations needed, whether that's roof and windows, structural, environmental in terms of water runoff, is it parking lot, all of those things. How far can you reasonably push rents to make a unit good, healthy, safe for residents and tenants? So, I think, it's okay to do some of that if you're going to provide a lot more. Obviously, keep pushing it, you're going to make the units unaffordable. So, to me, there's no bright line test for what should be considered NOAA and what shouldn't. But that is a significant part of it, right? Just being quicker to the closing table than another entity that maybe is looking to flip it into something higher end. And certainly Finance Fund and probably all the other entities I discussed are willing to be in deals like that. Certainly, at least for us, we're able to do it on the debt and the equity side. And the equity side runs through my department. So, we typically move pretty quickly, when we can evaluate a deal with a lot of speed. So knowing that that's really important. So certainly if you have anything, come to us if you'd like, and we can look at it. Apart from that though, one of the biggest issues is the production of new units, right? Like the pressure that new units puts on existing product is what pushes the rents down. It's a market condition. And while we are building substantial amount of units, we're not building enough in areas where the demand is high. So, in Columbus right now, we're not building enough units, period. Whether that's single family houses, Class A market rates, or affordable, subsidized, we're under all the time. So we're already behind, and we're further behind on the number of units we need. So, some ways that's a good problem in that people want to be here, but it's a struggle because it's, we need more units for people to actually be here, which doesn't help when you're talking about 300%, 400% lumber increases since last March, right? Like it's getting harder and harder to build. That said, all the first conversation I started with about, dealing with general contractors that can't lock in pricing that's good for more than 7 days, they're not stopping. And the developers and owners of the projects that they're hiring these guys for, they aren't putting their projects on pause because everyone seems to be a little afraid that it's going to be a long time before we even see this pricing again, that it's going to continue to skyrocket. When it drops, it might drop to this level. So, there is still a lot of demand from the production side of creating units. So yeah, I mean, NOAA is interesting. There's very actually little that's natural about it. It may not have received tax credits. It may not have received some other subsidy, but it was certainly created the result of policy decisions, whether or not that was more housing in that neighborhood, subsidized housing in that neighborhood, bike paths, greenways, roadway construction, zoning code, all of those things, all of those different, which people might think are very neutral decisions, absolutely affected the housing product that we might call NOAA now. So, it's not like it just was grown out of trees, right? Like it's not truly natural. There was public policy that affected this from day one. So any questions about NOAA at this point?
I didn't see any questions come in. There were a couple comments, and if you're okay, if you want those people to
sure.
elaborate. So Emily,
Please.
If you want to talk a little bit, and then, Phil, if you want to talk about Section 108 a little bit more.
Well, I was going to let Emily go first, but the Section 108 program's been around for a long time. Some communities use it, some completely stay away from it. It might be, for some reason, HUD is pushing it at this point in time. They've done a number of webinars. They've got another one coming up, I think, in a couple weeks. And one of the things they're talking about is actually using it to acquire properties that would be put in the queue for rehabilitation. So, potentially pairing it up with some of the other money that is flowing our way in a creative fashion just might work out.
Thanks, Phil. Emily, do you want to add anything about land trusts?
Yeah, I just take every opportunity to advocate for thinking about the future when we're investing in a particular neighborhood. It might be difficult to imagine a time when things won't be affordable anymore, but as our board treasurer, Kevin McGruder, would say, looking at his work in Harlem in the 80s and 90s, things can become unaffordable, especially if you're successful. And so just putting something in place, some sort of mechanism to create a stock of permanently affordable housing that can also help with neighborhood stabilization through ups and downs in the market. I just feel like it's always a good conversation to be thinking about future generations anytime you're making investments in a particular place.
Thanks, Emily.
Yeah, that's all.
And if you have questions about community land trusts, Emily Seibel has on multiple occasions offered to talk to you.
Yes, and do that. She helped get the Franklin County Land Trust off the ground with her advocacy, and I think, Emily, they ended up selling 30 homes in the land trust last year. So kudos to you for pushing this for so long, because it's starting to make an impact in some of these gentrifying neighborhoods now pretty quickly.
Are there? We can move on to another question if nobody has anything they want to add right now, because I know you have a couple more from registration, Jeff.
Yep.
Let us do that.
All right. So please describe non-LIHTC considerations for development projects. Yeah, I mean, it's, I would say that that's a really broad question. So I'll take it from a couple different standpoints. Assuming you're talking about some type of subsidized housing, it gets broken out into ownership and rental. So on the ownership side, there may be cities that put together home funds, recycled NSP funds. They may have their own bond revenue funds for home ownership. Those funds, and actually Emily alluded to this, so this is great, including land trusts projects, use those funds to create or to fill the gap of what is either a development gap or an affordability gap, or both. So you may have a home, we'll just use very simple numbers. I don't think these numbers are real anymore, unfortunately, but you have a home that costs $200,000 to build and you can sell it for $150,000, right? So there's, you have a $50,000 gap. You may use home dollars, or again, recycled NSP or bond, or I think maybe even some CDBG funds can funnel through this way, to fill the gap of that money. Some of it may come on the development side, on the construction side, so it's actually funneling to the developer to offset some of their costs, and then some of it may come directly to a buyer as a affordability gap that actually then continues to run with the land. That would have to be repaid unless they live in a home for X amount of time. We were doing a lot of that in the NSP days. It was kind of I felt like it was the Wild West. I don't know. I mean, I was pretty new to it, but so maybe others that had been around doing this longer didn't feel as much. But it was throwing out crazy amounts of gap subsidy on the development side, because we were trying to build so much so fast, and there weren't that many contractors after the crash. So our prices continued to be driven up, and this was a time, especially in Franklinton, where a home that might go for $350 today we were hoping to get 105 for, and that was actually a real number. We were over the moon when we got 105,000 for a brand new, or at least completely renovated home that had hardwood floors and I think some granite countertops. Just crazy to think about. So we're getting all this gap subsidy, but then on the flip side, we were finding buyers that, because of where we were pricing the property, which was based on the appraisal at the time, in that market, the gap wasn't on the affordability wasn't anything. It was maybe $1,000 or a couple $1,000s to help cover some down payment, because they probably didn't have a lot of cash savings. So what happened then when they went to sell the property? 5 years or 3 years later, and this happened, and the property went from 105 to now it's worth 155 or 180 or 225. Like, I mean, these are real numbers of real homes. They got to walk away with that whole appreciation, except for the affordability gap, which again was maybe $1,000 or $2,000. I mean, we weren't talking about a lot of money. The beauty of the land trust model is that in those situations, the appreciation, most of it anyways, stays with the property. So that, I know there's, and Emily could probably talk at length about the different ways of structuring this, but ultimately it helps keep home ownership's units affordable long term, so that it generationally maintains an affordability component. So to me, that's a heck of a lot better way, especially in a neighborhood that's kind of pushed past the can you get someone to live there in the first place to now it's where people are interested in being, and they have some means, but not maybe not enough to afford some of the higher end neighborhoods in your central city. So that's one way to do it. If you don't have home ownership subsidy, though, really there's no great way to do a development project unless you can find some design, some builder that can just build below the cost of the home. And even some of the most creative ways of doing that, prefab or different construction materials methodologies, in these urban neighborhoods, where the VAT program, which came through, or not the VAT program, we were doing a lot of demolitions, in the last decade. You're tearing down homes, and you would have these basements, and you would fill in the basement, to what you needed to create a grade, but you weren't compacting the soil so that someone could just come in and build on slab, typically on those foundations. So you're creating requirement for new basements or some type of geopier structure or something, right? So even if you can find something that you can get a box out there for 150 grand, your site conditions are still going to be higher. You have old sewer taps and old water lines, so you're working into alleys, and it just creates more and more expenses. So it's really hard, but for some sort of, and typically local gap financing. I mean, there are some other programs. Federal Home Loan Bank, I think, has someone can correct me if I'm wrong, but I think it's like 15,000 per unit still. That's helpful. Certainly there's some very, very low interest loans that you can get, interest rate loans that you can get. Some even as low as zero. I think actually a Federal Home Loan Bank has a zero interest loan fund that's up to $1 million. I don't know if it can be used for home ownership or not, but so there's some of that. But again, right now with where construction materials are and where construction costs are going, even with subsidy, it's getting hard. I just had a CDC talk to me the other day. We provided some loans on some housing units, and the government agency they were working with was going to cap them at $100,000 in subsidy, and they wanted to keep the home ownership new build units at a sales price of 200 grand, and couldn't make it work with $100,000 subsidy. There was going to cost over 300 to build a pretty efficient, incredibly efficient, actually, 1,500 square foot house. because you got into the site conditions and you got into, you know, the other demands that are the aesthetics of that community. And, you know, that same house cost 220 the year before. So, you know, it's really, really a challenge on some of this stuff. So, you know, you can get really creative on designs and construction methodologies, but ultimately you're going to need some sort of subsidy. And typically the best subsidy is going to be at the local level for home ownership. For non-home ownership, subsidized rental housing, non-LIHTC, excuse me, subsidized rental housing, there's a little more, thankfully. There's more resources, and there's more that you can maneuver, because the perm debt can really become a significant component of the project. You know, if you can push that interest rate further and further down, you know, or you can delay the time that you need that loan to actually be drawn, you know, you can actually lower your interest and therefore increase your debt service. So, you know, there's definitely considerations there. You know, Federal Home Loan Bank does have a, it's called their AHP program. You know, it's $1 million grant. It's good money, but it comes with a lot of hurdles. It's a very competitive process. So, you know, to get that money, you're committing yourselves to a lot of things, and you're committing yourselves to pretty low, probably very low income targets and low rates. You know, working probably with a special needs population, depending, you know, you're looking at sites that are maybe more rural at times, or at least meet different, sorry, someone's maybe not needed. All right, there you go. That's funny. So, you know, there's some components of providing for that funding that make the, you know, it's certainly not free capital, and the money doesn't come in on the front end. So you're going to have bridge financing in place to make that work. You know, so that's one source. Certainly, if you can get money from the local government, again, that's huge. You know, whether that can be home funds, CBDG funds potentially, you know, for some of the infrastructure, other things. You know, maybe again, NSP recycled dollars. You know, they may have some general revenue dollars. A lot of the bigger cities are going towards that. I know Cincinnati is looking at creating a bigger fund. I think maybe they already put in 30 or 35 million into a fund there. So, you know, there's some significant aspects to that. You know, Finance Fund has smaller grants, right? 30,000, 100,000. You know, we can do lower interest loans depending on the location and who you're providing the housing for, right? So, you know, but it's really challenging. Of course, I'm sorry, I hate saying that. It's all really challenging right now. I'll describe to you our non-LIHTC permanent supportive housing project. And again, you know, for some of the CDCs here, I apologize, because ultimately it's going to come down to we got different money. So we acquired 2 hotels on the west edge of Franklinton. And as Finance Fund, we had money to do that. We didn't have to go find some other source. We were able to source that ourselves, which was fantastic. We've had a little bit of a buy and hold strategy while we tried to come up with a new program and what to do with these units. And we ended up keeping 4 of the 7 buildings and converting those 4 buildings that totaled 62 units of, you know, 1970 shotgun style, 286 square feet boxes that were built, you know, put side by side, and then had one backup to each other unit. We converted them into 62 efficiency apartments, provided 4 healthcare offices and a large community space for transition age youth, so 18 to 24-year-olds, most of whom were either coming out of the foster system or were homeless. And so that was the project we created, and we got a service provider that worked with this population for the last 15 years and had healthcare on site with Mount Carmel and integrated services and others. And it was great, but the reasons that it worked are we got $1.6 million from the city, we got $400,000 from the county, we got $1 million from the Federal Home Loan Bank, and then our partners raised another $500,000 from another 14 sources, and then Brittany, who's on this call, Finance Fund, she helped us get 18,000 from Google. You know, I mean, it was little bits here and there, and then we have a permanent loan from a member bank, the Federal Home Loan Bank, who's going to lock us in at a very low interest rate, and all of that, you know, all of that subsidy, and it's still a struggle. We got incredible discount to provide community-wide Wi-Fi and television, you know, at a price that was absurdly low. You know, we have incredibly efficient units. Our redesign was incredible. You know, and there's very little maintenance to the project now. You know, and even still, it was a challenge. And then we went out and got 62 project-based vouchers on a 20-year contract. And are looking at property tax adjustments. So, you know, we're doing everything we possibly can, and to make the project work, to underwrite it at a 7% vacancy, which on a subsidized project like this is kind of silly high, but you know, to underwrite it as they want 7%, they have the operating expenses where it needs to be with 3% of, you know, appreciation and 2% on the revenue. You know, it trends just barely cash flow positive for 15 years, you know, and it fits within that bandwidth of the underwriting of Federal Home Loan Bank, you know. So it's, you know, it's really, it's a struggle to make those deals work. And at this point, that was the first deal Finance Fund started working on when I came on board in July of 2018. So, you know, I think we closed sometime in November of 2018. So we're well into 2.5 years on this project, and our total fee for it probably doesn't cover all of the staff time of all the staff that had to touch this deal. And that's with me out there at 4 in.the morning trying to fix water line breaks myself, because we didn't have any money to call a contractor at the time. I mean, you know, it's a passion project, as you say, at this point, and it means a lot, and hopefully it makes a huge impact on the residents. But, you know, $4.8 million and no tax credit subsidy, it's really a challenge, you know. So, you know, that's one deal we've done. Now, if you get into other unsubsidized projects, you know, it gets a little bit easier. It gets a little cleaner. Right? You're only looking at debt and equity. You know, I talked about our Vera project. You know, and it's a huge deal. You know, 114 units with commercial space and a couple different amenity decks, and you know, the whole thing. And you know, ultimately, we have efficiency units and 1-bedrooms under $900, and 2-bedrooms starting under, you know, $1,500, which in downtown is about a 15 to 20% discount of the projects adjacent to it. You know, and coming online at that price is pretty great. You know, we feel like that's a pretty big win. But you know, that is us essentially designing to a square foot rent per unit that makes sense, that can pack in enough units to make it work. You know, providing enough parking, not just for now, but in the future. Foregoing any type of fee on the front end. You know, providing a mezz debt on the construction, and hoping we get really good pricing when we go for the refinance, either through Fannie or Freddie or HUD in, you know, 18-20 months from now. So, you know, there's a lot of risk to that, you know, and, you know, Finance Fund put up multiple millions of equity for that deal. You know, now, of course, you could do something much smaller, but, you know, there is a benefit that comes with scale. Now, you know, if you're not in a downtown urban, you know, have to build a parking deck or a parking garage and then put your units above that, and you start looking at 3-story walk-ups, and that price per square foot is substantially lower. It's the lowest cost construction. It's what you see around the outer belt of 270 and probably in most cities, because it was the cheapest to build. It was the quickest to go up. It's accessible, and if they have enough land, they could put a large parking lot on there too, and it's the lifestyle community designs, right? So it actually can help lower those rental numbers and create maybe not quite what we consider affordable. It's certainly not going to be 60%, but it might be 80, and you might be able to get most of the units at or below 80%. So if you can find good land that's still accessible, that you can build something like that on, you're doing really well. Or if you can find it maybe in maybe not the hottest neighborhood in a city, and work with the community to find ways to get that design to be more palatable, then maybe that's what you can build, and go that route. Everything you can do to lower the construction side, meaning lower the debt, or lower the equity requirement, or both, can help on the operating side in terms of lower rent numbers. And if you have open corridors like the 3-story walk-ups typically do, you're not heating a corridor, right? So over the lifespan of 20 years of a project, you don't have long hallways that you're heating and cooling. But you may have more exposure to the framing in terms of steps. So there's still some maintenance concerns to consider as you're doing this. But it's as simple, honestly, as that. I mean, things you can do to lower the cost: go try to find sales tax exemption. Commit to a number of units at a current, at a rental rate that makes sense. Find some maybe some healthcare provider that's willing to do some on-site services and maybe pay kind of high market space rent for a couple thousand square feet to put a little healthcare clinic in there. You can do things like that to help generate some other revenue. I mean, I've seen a lot of pro formas, and honestly, what a lot of developers will do is they'll keep their rental rates, their base rental rates down, but then they're nickel and diming every single tenant with large lease fees and a community surcharge and pet fees that are $400 and a mailbox fee, like all of these things that at the end of the day maybe it was $1,000 base rent, but it's $1,100-1,200 by the time all these fees go in there. So I don't really find that to be any more affordable than anything else. So I think that you're really looking at again looking at 4 sides. You got the subsidized homeownership and rental. I think there's more opportunities on the rental, although I think demand for homeownership is huge. It's just it's single family houses take a lot longer to build, and they're more costly than trying to build multifamily. The multifamily rental space that's subsidized, you got Federal Home Loan Bank, you may have some city funds, but again, they're challenging. And if you're going to take that on, realize this isn't going to be some cash windfall. Certainly developer fees on a tax return deal are going to be the highest that you can get. And if you're looking at unsubsidized, really that just comes down to how creative can you get with your designs, how low can you get your land, and can you find rental rates that both service the debt and are considered affordable. So I don't know that there's any more magic sauce to it than that.
Thanks, Jeff. I don't see anything happening in the chat. I don't know if people have questions they want to add. I feel like you have at least one more question that was submitted also though, right?
Yeah, that was real easy. I can answer that. Yes, we're looking for an experienced nonprofit developer who would partner. Please reach out. We do that all the time. So yes, please connect with us. And again, there are other organizations that do this. Those partnerships, though, if you're going to look at non-subsidized or non-LIHTC projects, it's going to be the small things that'll make the big difference. It's can you push the interest rates down? Can you defer some fees on some, those are going to be the things that are going to be huge. Can you find partners that'll put up more equity for a smaller slice of the pie? Because again, let's say a project costs $1 million and you get 80% of that as a loan. If you put in $150,000 as a private investor, that doesn't necessarily mean that you're taking 75% of the equity and ownership. Like, there are ways to negotiate the deal so that you're trying to hit target returns for your investor, which, means that maybe you can make more on the cash flow side or actually make a developer fee, that help keep the lights on and keep the projects going. So, it's going to be the small things that'll make the big difference. I think that with that said, that's where Finance Fund has had some real benefit. And why we keep getting calls from people is that our money is pretty good money. And it's not just that the rates are good and our terms are typically below what anyone's getting out in the market, but that we're quick to do it. Typically we don't take 6 months to underwrite something. So yes, to that question, we would certainly love to partner, and please reach out. Yeah.
Thank you. And then I think that's all you had, right? Yeah. Questions.
That's it.
So we have, I'm going to go ahead and actually stop screen sharing. So everyone's back, but we have about 8 minutes. If people have questions that anybody wanted to contribute or ask an additional question, because we recognize, I don't want to say Jeff is really, okay, I want to say Jeff is really smart, but I don't want to say Jeff is the only smart person in the room, right? And so I know there's a good amount of experience here. So if you have things to add or another question, this is your chance to do so.
Just wanted to say that I have reached out to Finance Fund, and I still haven't gotten a response from anyone. And this was when we had the last Zoom meeting, I think it was the 401.
From last month, April 22nd?
Yeah.
Okay.
Hey, Sherry, this is Bernie Bolton. I do a lot of our external relations. I'll throw my email in the chat right now. Send me your question. I'll make sure it gets to the right person and we get back to you.
All right, thank you.
Yeah, sorry about that. Also, sorry to jump in, Jeff, if you were.
No, that's, yeah, thank you.
Sorry,
You can see that.
Sorry, I joined late. So I'm looking forward to watching the rest of it on the recording. I had asked the question about a nonprofit developer that would come to Lancaster and partner with one of our social service agencies here. So I'm going to put my email address in the chat, and if there are any other experienced CDCs on the call who are open to expanding beyond a particular geography and would be open to talking with us about, possibly coming to Lancaster and helping us out, we'd be really interested in that.
Thanks, Linda.
And my background is actually in nonprofit housing development, so that's why I want to see who we have in the area before we go to like a for-profit, partner.
Nice.
I'm leaving space in case people have questions, and I'm going to send out to all of you that registered, this recording and some of the resources Jeff referenced throughout the session. And then a couple of you have put emails in. I'm going to share that with, the registrants as well, since there is good knowledge here. If you have any final closing notes that you want to end on, your major takeaway of the day, if you have one.
Yeah, I would keep it simple. Still seriously a lot of challenges out there, but with a lot of challenges, again, come a lot of opportunities. And clearly the need for affordable housing is as serious now as it's ever been. So, just again, encourage you all as you do the good work of providing housing for those that need it most.
Thanks, Jeff. Thanks, Brittany. And all of you that asked questions beforehand and now and during and participated. Again, I'm going to send this recording out sometime this week with some other resources. If you have more questions for Ohio CDC that we can help point you in a direction, if you have a question for Finance Fund, I'm going to have Jeff and Brittany's emails in there too, so you can reach out to them directly. But for now, thank you again for joining us. I hope it's a beautiful day where you are. It is in Columbus, and that you can get outside for even a few minutes today, and have a great rest of your week. Thank you.